The ECB look set to dominate the headlines on Thursday, the 12th of December, as they come forward with an interest rate decision that by and large, we are expecting to see a 25 basis point cut, but we are seeing some potential for a 50 basis point move coming on the same day as the SNB are likely to cut rates, a day after we see the Bank of Canada likely cut interest rates. So a big week for central banks, but let's focus in on the ECB as they really have to weigh up whether the concerns around France, Germany, and the US are enough to see them push in with a double interest rate cut this time around. So let's jump into some of the charts that I've got prepared for you guys. First and foremost, this is the breakdown in terms of market expectations according to the London Stock Exchange Group's Icon platform. That points towards an 85% chance of a 25 basis point cut, just a 14.6% chance of a oversized 50 basis point move. Now, let's bear in mind that the norm really is 25 basis points, and the 50 basis points should only generally come when they need to take drastic measures and they need to sort of play catch up. Is that the case this time around? Well, what's different? What we have seen is the breakdown in terms of the political system over in France, and there are significant concerns over the ability to get a budget through that will essentially put the financial position of the French economy on a stable footing. The previous budget was supposed to do exactly that, but we're not seeing that coming to fruition with Michel Barnier being pushed aside. At the same time, we have the continuation of the weakening of the German economy, with manufacturing being at the forefront of that, as essentially the automotive industry moves on without Germany, a lot of that moving over to China, as we see EV really dominated by Chinese names, and of course the likes of Tesla. And third of all, we have the US. Of course, Donald Trump has come into power. He's coming into power. He has, of course, claimed victory. What's that going to mean? Well, a likely breakdown in terms of trade relations with an imposition of tariffs on European exports or Eurozone exports, because they have this major trade surplus with the US. That's not the case with the UK. The UK suffers a deficit with the US, so likely going to have an easier time. But nonetheless, there is a need for the ECB to act. Now, bear in mind, this meeting also has economic projections. Now, economic projections, by and large, generally reflect changes within the sort of economic system, within the political system. And so what out of those that I've mentioned are going to be priced in? Well, the German side of things to an extent, but they've been in trouble for a while now, so we don't expect to see a huge amount of difference there. The French side of things, well, yes, we have seen a shift in terms of Barnier not managing to get through his budget and being pushed out, but at the same time, we don't know what the solution is. We don't know what the answer is and the implications for growth, and therefore that can't really be factored in when it comes to the projections. And third of all, the relationship between the US and the Eurozone. Well, Trump may have won, but we haven't seen him in power. We haven't seen him enact the tariffs that they can then build assumptions off the back of. So you have this curious position where we have what we expect in terms of France, in terms of the US trade relations, and then we have what they can factor in, which is not that much, quite frankly, because some of it is still unknown, even though we kind of have an idea of what's going to happen. And so the ECB members can either make decisions based on what they think and what they presume, or what they are pointing out in the forecasts, which is essentially casting aside a lot of what they believe is likely to happen in terms of the French political situation and the US. And so that's the position that they find themselves in. That's what's really interesting about this, because there is a justification of a 50 basis point move. At the moment, we're pricing it at 14.6. So it's certainly an outside possibility. But nonetheless, there is a justification for that. And I'm sure there will be ECB members that are feeling that way. Looking beyond that, you can see essentially, if you look at the most likely situation, we're talking about 25 basis points in December, 25 in January, 50 basis points in March, another 50 in another 25 in April, and then essentially a coin toss in June. So there's an expectation that we see either 25 or 50 basis point cut at every meeting. And you might cast your mind back and remember that that was the situation that we had for the US, right? And then things have changed pretty heavily. And there's a reason for that. The US inflation picture has changed, and the inflation expectations picture has changed. The economic picture certainly isn't worsening to the degree that people had called for. Remember the SARM rule and the pop in terms of unemployment that never really sort of kick-started a massive surge like people had been calling for. So much of that has been cast aside in the US. However, with the Eurozone, the economic fears are real, and we're not seeing a massive improvement on that front. And the inflation picture has improved significantly. Now, this is the picture in terms of interest rates. So what we can see here is that the ECB and the sort of orangey yellowy line have already cut rates on 3 occasions. And there's an expectation that they will cut again. So a fourth time within this cycle, very different to some of the other central banks within that at the sort of top end of this scale. And also notable that they've been relatively steady in that progress, generally 25 basis point cut each time, whereas you can see some of the other banks listed here, the likes of the Bank of Canada, the likes of the RBNZ, very steep declines. So they're really sort of trying to move pretty quickly, quite frankly, whereas that's not necessarily the case with the ECB. Potentially that changes this time around. And so, if you're looking to compare them against other central banks, you can compare them against the RBA. You can see they've just paused rates once again. I think that was the 9th consecutive pause. You can compare them against the sort of top end of this, where we have the Bank of England, where we are cutting rates, but it's at a relatively slow clip. We've also got the likes of the Federal Reserve, which again, they are cutting rates now, but it's not necessarily something to write home about. And there's a sort of slow pathway lower expected. Comparing the Eurozone to those two that are sort of at the top end, where rates are still high and the pace of easing is slow, we can see here in terms of annual inflation for the UK and the US versus the Eurozone, it's relatively similar. You can see that the US is at 2.6, the Eurozone UK 2.3. So both of them pretty much where the central banks are probably quite happy to cut interest rates, which is why they're doing exactly that. However, when you look at the core, that's where things look a bit different, because you can see 3.3s across the UK and the US, and then the Eurozone 2.7%. So the Eurozone has managed to really drive down inflation across the board to a greater extent than some of these other economies. And that is really key here, because headline inflation is all well and good, but a lot of that's going to be influenced by things that are out of the control of the central banks, the likes of food prices, the likes of energy prices. Core inflation is where it's at. And that's why they say the core PCE price index is the most important metric for the Federal Reserve. Well, you can see here in terms of core CPI, both the US and the UK have some way to go on that front. The Eurozone have been doing a good job of it. And arguably, you could say, well, that's because they've got a weak economy and they don't have the same kind of demand picture. That is the case, certainly for some elements of the Eurozone. Of course, it is a significant group, so you can't necessarily say the same thing for everyone. And then if we compare things in terms of recent inflation, this is really interesting, because essentially you can look at an annual figure and say, for instance, inflation is 10% somewhere, right? And that is really shocking. However, that 10% might have been formed up of a huge amount of inflation 6 months ago and beyond. And then the recent months, we've seen nothing, right? And so you would know, if that was the case, that in 6 months' time, it's going to all be cleared out and the year-on-year metric will be driven down in a really sharp manner. So basically, the proximity of that inflation on a monthly basis is what's really important and tells us the sort of direction of travel for inflation. And so I've done it on a 6-month annualized and a 3-month annualized. So on the 6-month annualized, you can say, well, Eurozone at 0.6%. That's how it's tracking over the past 6 months. So it's on the right trajectory. In terms of the 3-month, it's even lower, minus 0.2. So Eurozone inflation has been curtailed. Certainly, this is the headline numbers anyway. And then we look elsewhere. Well, the UK really has seen a pop recently, 3.6 on the 3-month annualized, 2.3 on the 6-month annualized. So things looking all right on the 6-month, but certainly the UK is, there's some jitters there with the latest monthly reading. And the US, 1.4 on the 6-month, 2.5 on the 3-month. So what you can see is there has been a sort of uptick on that front in terms of the last few months. Bear in mind, these are headlines. So also it's not going to look much better in terms of the core. Tell you what, next time around, I'll create that chart for you guys as well. So what about the economy? So PMIs are a leading indicator of economic health. The composite should give you a sort of overview of the entire economy. And then you've got manufacturing and services breakdown. So what we can see here is that out of the 5 economies I have here, it's the Eurozone that's the only one below the 50 threshold. So it's in contraction, led by manufacturing, which manufacturing has been weak across the board generally, but you can see that manufacturing is particularly weak in a region that's heavily reliant on manufacturing. Services also in negative territory, sub 50, and that can't be said for the rest of the pack. So inflation to a large extent under control, and then the economy in need of action. Here is that core inflation metric. And if we want to talk about, is the inflation recent or historical, this tells you exactly that, because the 6-month annualized at the bottom at 0.55 highlights that core inflation is a thing of the past, right? That happened at the beginning of this year. So you can see February 0.67, March 1.1, April 0.7. Those 3 months alone take you over the 2% mark. So that means, granted, we've got a big negative number in January, but you can sort of pair that off against one of those readings. And in which case you're going to see, over the course of February and April, let's say, over that period, you're probably going to see another 1% taken off of the core inflation metric. And therefore, I would say by the midpoint of the year, you're going to probably see inflation below that 2% mark. We can't necessarily say that in terms of the trajectory for the likes of the UK, for the likes of the US. And that's why we want to chart the likes of the euro against the US dollar, but also against the pound. So what I've got here is the Eurozone 10-year yield against the UK 10-year yield. That's the orange line. And plotting that against euro sterling. And you can see there's a close correlation. So essentially, the 10-year yield it reflects a number of things, but to some extent, it reflects the perception of inflation and interest rates going forward. If inflation is ticking higher in the UK compared to the Eurozone, or if Eurozone inflation is coming in weak, if the economy is coming in weak, then that all points towards lower rates compared to the UK. And that's what we're seeing here. And so if we see this ECB meeting cutting rates by 50 basis points, you'd expect to see the 10-year for the euro area coming lower compared to the UK. And then you'd expect to see euro sterling weaken. What we could see is a 25 basis point cut, which is expected. You see a little bit of an uptick in terms of euro sterling as we see that sort of 14% chance fade. But I think, the trajectory is relatively clearly, it's very clearly defined here in terms of euro sterling and the trajectory for the euro area versus the UK 10-year yield. Now, let's just quickly jump into the chart. This is euro sterling. From a daily perspective, you can see very clearly we sort of consolidated at the beginning of the year, but then we've been heading on this downward trajectory. The breakdown through 0.826 highlights the continuation of that. And the next port of call, really, if we go into the monthly time frame, is this low here, which is at 0.82. The lows from March 2022. If we break that level, we'll be talking about the lowest level since 2016 for euro sterling. Well, the downtrend continues apace. You can see here coming back up towards that trendline resistance and now breaking lower once again. So until we break out from this trend, which would mean a breakthrough trendline resistance, a breakthrough 0.83, the bears appear to be in charge. And especially if we did see either a 50 basis point cut this time, or in the post announcement comments, they sort of indicate the possibility of a 50 basis point cut next time around. Well, that's the kind of thing that could drive this pair lower once again. Also look out for those economic projections, because of course, if they're expecting economic weakness, then you would think that they have to react in kind. This is the DAX in relation to the S&P 500. What's notable is, yes, we saw some jitters around the US election result, because of course we don't think it's going to be favorable for the German economy, Donald Trump coming into power. It's reversed entirely, that relationship between the DAX and the S&P 500. are we at a level where we're going to start to see the DAX underperform once again? We've sort of seen that kickback. Time will tell. Another thing worth noting, why am I talking about the DAX if we're talking about potential longs or a long trend? Because, you could maybe look at something like the CAC. Well, this is the relationship on the daily time frame between the CAC and the DAX. So if you're looking for a chart to be long or short, it's always worthwhile jumping onto TradingView and trying to create that relationship, right? So, just like you have for, say, euro sterling or the currency pair, you can do the same kind of thing for indices. And you might say, I think equity markets are going to rise over the next week because X, right? Well, which one is going to rise the most? And so you can start to form relationships and say, what's the ratio between the FTSE 100 and the Dow Jones Industrial Average? Things like that can point you in the direction of the strongest of the pack for you to be able to try and find the strongest trending market. And you can see if we're looking at sort of major Eurozone markets, it's definitely not the CAC given what's happening at the moment, but that's been a prolonged downturn. You can see it's rolling over once again as the DAX is dominating. And so we move finally onto the DAX. This is the 4-hour chart, but let's go on to the daily. That substantial rally coming into play through the back end of November, moving into December. We're pausing a little bit. The first down day in a while posted on Monday. And so the question mark here is, are we starting to roll over? The 15-minute chart could point towards that, given this sort of trend has now seen price action breaking down through that first swing low. So there's a little bit of caution to be had. I would say look out for, if we're looking from a fib perspective, you'd be looking at, let me just see if this, there we go. So basically, you'd be looking out for the potential for resistance at 20424. But ultimately, the way that I would play it is there is a possibility that we roll over, but we've got a clear-cut bullish trend in play here. So it would take a break up through 20475 to look for that next leg higher. Until then, are we in a retracement phase? Possibly. So, that's something worth bearing in mind. And if we see the 25 basis point cut, are we going to see a little bit of pessimism? I doubt it. I think that, it's going to come down to also the commentary that comes out around it, the economic projections and the like. At the moment, we've rallied into the 61.8 Fibonacci. We've pulled back a little bit, starting to strengthen once again. I wouldn't be surprised to just push onwards and upwards from here. But certainly, I think greater confidence comes with that breakup, considering we've only seen a relatively shallow pullback. That breakup through 20475 really tells us that this pullback phase is over and that we're potentially going to see another strong move towards the upside, and then looking for this swing low that we've recently created around this 20300 kind of mark, 20256, as the sort of area that we'd need to break through to negate that bullish trend. That's if we break through resistance. Until that happens, watch out for these Fibonacci levels, the 61.8, which is at 20393, and then the 76.4, which is 20424 as resistance levels as we try to regain ground. But see it on a 15-minute chart, we're creating these high highs, high lows, starting to turn upwards once again as I speak. But let's see how it plays out. Certainly the trend is a bullish one as things stand. And the DAX has enjoyed plenty of good fortune against the CAC and also against the S&P 500. Let's see if we can actually break through resistance and continue that outperformance of Europe, which by and large is a rarity, because as we look over the long term, we're quite used to the idea of US markets outperforming. And certainly Donald Trump has helped that narrative. But that Trump trade's starting to fade. Certainly, if you look at crypto markets, they've been taking a bit of a hit. Bitcoin less so, but the alt market really weakening quite heavily. And, that's been one of the big benefactors of the Donald Trump trade. So, yeah, I hope this has been useful. It was the second one I recorded of it because we had a tech issue with the first one. So hope this one works fine. Obviously, coming into Christmas, we'll continue to get lots of content for you guys over the period as we look into the sort of Santa rally and looking into the numbers around that. We're also going to produce some content as an outlook for the year ahead and the big events and the big things to be looking out for. So plenty to come from the channel. Make sure to like and subscribe. Have a great day. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Thank you.